Um, I'm very happy to be here. My name is Mustafa Ndaju. I'm the Executive Director of the African Center for Tax and Governance. I am privileged to moderate this session today. And this session is on tax elements on illicit financial flows and developing countries. We have a stellar cast of speakers. Two of them I know very well, one I also know. And I assure you that this session is going to be very interesting. And I like the flow of this conference, how we started all with the overview and now going to looking at specific areas and having these experts in these specific fields speaking to these very, very important issues. Ground rules to the speakers. We have 10 minutes each, after which, if you all present, we'll go into a Q&A session. So we'll be very strict with time because we're not doing so well with time coming from the first session. So I would like to introduce our first speaker of the day, Joy Waruguru Dubai. Joy is from the Institute for Australian and International Tax Law. She's an international tax expert. She's currently completing a PhD in tax, not surprising. She has experience in both private sector and the NGO. She's worked with the KPMG, ActionAid, Oxfam, TGNA, and many, many others. So her topic is digitalization of the economy, taxation challenges for the global South. Joy, the floor is yours.
Good afternoon from Vienna, where it's a really lovely day. You can see my background looks like a beach. I just thought, since it's the weekend, we can feel a little bit relaxed while we hear about tax. I'll try and keep mine short. We have 10 minutes, so I'm going to push through each of the topics. I was asked to cover quite a broad topic. I mean, digitalization of the economy, focusing on the tax challenges and how tax administration and combating IFFs can benefit from technology and the use of technology for administration. So I'll just go right into it. May I ask for the next slide? Thank you. So to start off with, I think this is probably the debate that most people are most aware of and has been, reported significantly on in the last few months. And this is focusing on the main challenges that digitalization causes for tax collection. So BEPS 1, as you all know, did not comprehensively address the challenges of the digital economy. And so the main issues that arose, and this debate kind of started off in 2019, were that the current profit allocation rules were based on physical presence and were therefore not sufficient to address some of the new business models emerging in the digital economy. And for example, new factors had emerged, like the concept of a user, and data had become much more valuable. So holding data about you and your preferences can earn income for a company. So this discussion then went over into the OECD Inclusive Framework. They began negotiations on how to address the remaining challenges of BEPS and the challenges that the digital economy was raising for taxation in general. And this brought about the proposal on Pillar 1 and Pillar 2. And to briefly explain to you Pillar 1, Pillar 1 is about the reallocation of taxing rights, and it has elements to it which are Amount A, which focuses on allocating profits, or what we refer to as residual profits, to the market jurisdiction. And the most recent statement from the OECD, which came out on 1st July of 2021, this statement actually clarified that this residual profit will be profit in excess of 10% of revenue and would be 20 to 30%, and they would use a revenue-based allocation key to determine how much revenue will be allocated to the market jurisdiction. Of course, there are questions. 10% of an amount is quite small. It could potentially be quite small. Amount B then focuses on the fixed return for baseline marketing and distribution activities that take place physically in the market jurisdiction. And just to clarify, the market jurisdiction is where the users are based, and this is where, for instance, we have Airbnb that has quite a few users, both in terms of the customers and the actual hotels or houses being marketed on the platform. So what we're talking about is where their marketing activities tend to take place. And then we have the final element, which is tax certainty. And this tax certainty element focuses on really amount A, or the residual profits, and the likelihood of disputes that will arise. And it looks at dispute prevention and dispute settlement. And the main proposal around this is the use of mandatory arbitration, which is a concern for most developing countries. We then have Pillar 2, and this is where the minimum tax proposal arises. And I'll just focus on this minimum tax question, which has been the subject of discussion and debate for quite some time. And this minimum tax is proposed to be about at least 15%, unlikely to be much higher than that. We're not sure if it could be less than this, but this is the proposal that has been put forward. I won't go into the details of how this proposal came about, but hopefully you've all kept in touch with the media reporting about the role of the United States, the debates in the UK, and so on. And in the face of all of this multilateral discussion that's been going on, we've also had unilateral responses to the digital economy. So for instance, Kenya has introduced the digital services tax. And the final statement that was released by the OECD stated that they were going to work to eliminate digital service taxes. So countries like Kenya, India, and more are now aware that there's a potential for digital services to be eliminated. Kenya, as a result, did not support the final statement that came out, and it will be interesting to see what happens in future negotiations. There are also implications for VAT, and what's been interesting is VAT is now being amended in countries like Kenya, of course, being considered in Rwanda as well, how to capture the digital marketplace. And I think the future of VAT in this area, I think, is quite interesting and needs to be discussed much more. Of course, South Africa has already been implementing VAT on the digital marketplace, and there are significant lessons that we could learn from this. I'm sorry, I'm moving quite fast. I'm just aware of the time and the constraints of time. One big discussion we've been holding at the Institute is about the implications for investment incentives. And, more and more we are seeing that the tax space is now interacting with the investment policy making space, and largely with bilateral investment treaties. We've seen more cases in investor-state dispute settlement relating to taxation, most recent and most controversial being the India, Vodafone, and CAN cases. Now, here in this space, we are still trying to evaluate what will happen, or what are the implications for eliminating investment incentives because of the discussions or the expectations in the tax space. Of course, this could lead to future disputes in the investment space. This could lead to investor protections being violated. Of course, there's legitimate expectations that are held. We also are looking into the trade spaces and what the implications are, of course. And if there are any questions about this, I'm happy to also further discuss this. Next slide, please. Quickly moving on, the digital economy has also brought about opportunities with the technology that's emerging. And one of the things we are looking into is how tax administration can take advantage of new technologies and the ways in which they can begin to take advantage of new technologies. So, of course, there needs to be a roadmap towards adopting new technology. For example, you already find that a number of authorities are using e-filing systems. So online iTax in Kenya, online filing in most countries is now common. You can file your tax returns, your VAT returns, which is all quite possible. But the big question we are asking ourselves is about data management for administrations and the benefits from big data, data analytics, and artificial intelligence. The biggest benefit we see, not only in managing the actual data, but evaluating the data that's held. So you can use the common characteristics of a specific tax crime or certain tax avoidance schemes, input them into the system, and using AI, you can actually red flag these common transactions that have these characteristics, and this can ease the audit process. This would be very useful, in fact, in easing the capacity of tax administrations. And what we've seen is we have a few customs authorities across the continent that are testing the use of big data and data analytics. It's quite fascinating, and if you'd like to hear more, we have an ongoing project. We're also working on the use of blockchain. Next slide, please. We're especially, of course, interested in how technology can assist in combating IFFs. And again, of course, the focus is data management. It's important to understand that authorities deal with a wealth of data. They're receiving beneficial ownership information, legal ownership information, customer due diligence, know your customer, suspicious transaction reports, cash transaction reports. And if you were listening to Director Kanyile's presentation previously, you'll understand that they deal with so many reports coming in on a daily basis that they then need to translate into intelligence data that can be consumed by other authorities or other reporting institutions. How can you manage this data and how can you take advantage of technology? We have begun to look at blockchain and specifically distributed ledger technology, which allows for this decentralized ownership of data. And this can then connect the data to one another. And you can then implement data analytics and AI to actually evaluate this data and identify the red flags, which could be extremely interesting and useful if you're trying to understand the entire criminal network. Of course, this must be primarily based on interagency cooperation. Different authorities deal with different data. They also deal with different aspects of a crime. And if you're able to connect their systems, ensure interoperability, but also respect privacy and security, there are great benefits in terms of detecting at an early stage, investigating very quickly, and hopefully prosecuting and recovering the assets. Next slide, please. So what will it take? As I mentioned, a roadmap is absolutely necessary. One must understand that cultural change is necessary for the institution. You must look at the human aspect and you must look at the systems that are available and how they're being used. Ownership of systems and tools is extremely important. This type of data is quite sensitive. You're holding data about your citizens and probably beyond. You cannot have an institution like, for example, Microsoft owning part of that data or the system that hosts that data because they may have rights to use that data. So it's important that authorities build the capacity within internally in order to actually maintain and host and keep the system going and run the system. Human capital remains extremely, extremely important. So us saying that the use of technology in administration is growing and it's important does not mean that human capital is no longer as important. Actually, what we find is that if we put these two things together, it makes it a perfect combination for the system. So human capital is used to identify these characteristics, these common characteristics of crimes, identify patterns and put them into the system, feed them into the system, and it comes back around with an investigation that hopefully can be followed through by recovery and prosecution. It's important to also understand the risks. Privacy has come up as the biggest issue, including in the blockchain area. We're still not sure, with blockchain, everybody is able to see the data that's held. So a big question that has been raised is how do you ensure that people who are not supposed to see that data do not get to see that data, and it does not compromise the ability to actually evaluate the entire transaction. And we, of course, need to continue to reflect on new solutions. The digital economy is still emerging, it's still changing, it's still growing. And I think we have a great benefit across the continent because we're still dealing with young, growing systems. We can adopt and adapt very quickly. We have manual information that can be inputted over time. We can test new solutions. And this is actually taking place. Currently, there's ongoing projects with the World Bank and a few customs authorities across the continent that are testing out new solutions, and there's greater interest in blockchain, for example. So I'm happy to share more information, and just to mention that our VU Global Tax Policy Center, we've been working on the role of technology for illicit financial flows in the new trade environment, especially with the CFTA ongoing or the implementation ongoing. So we would be happy to invite anyone who's interested to get involved. Thank you.
Thank you very much for sticking to time. You agree with me, that was a very interesting and very brilliant presentation. Unfortunately, I would love to hear more, but time does not permit us. For me, I would say what I find fascinating and mind-blowing is that going forward, the future of tax is that the possibility of using AI for tax compliance, taxpayer behavior, I find that very interesting. And perhaps I'm sure some questions will come up in this area. Another thing I think might be interesting to our audience will be to know if Kenya has started implementing the DSDs and any lessons so far. Thank you very much for that brilliant presentation, Joyce. So we go on to the next speaker, Dr. Alexander Ezenabu, who is a professor at the Hamid bin Khalifa University, based in Qatar. Alex is an international tax expert. He's an expert in taxation, investment, and development. He has worked and consulted for many international organizations, the likes of UNDP, International Center for Tax and Development, TGNA, and many more. His topic is a case study of transfer mispricing, select multinationals. Alex, the floor is yours.
Thank you for the introduction, Mustafa, and also thank you to the organizers for the kind invitation. And also to all previous speakers. It's been interesting hearing from everyone and learning quite a bit. I've been given a very simple task, which is to just say some stories about transfer mispricing that I've come across. However, for anyone who is wondering what this conversation is about, I am going to try to, in very few minutes, give sort of a background as to why there's transfer pricing in the first instance and why we're having this conversation. I wouldn't speak a lot about the connection with EDC financial flows. I think people like Lucky Star have done a great job, and I wouldn't want to repeat what they've said. Transfer mispricing or transfer pricing in the first instance developed from the enactment of tax treaties, right? After the First World War in the 1920s, it was important that the world found a solution to encourage companies to go abroad to do business. And companies at that moment had complained of the issue of double taxation, where the subsidiaries or sort of other sister companies who were trading in other countries were being taxed on similar income that would come back to their own countries, which would also get taxed. So there was that conversation around what do we do? And that conversation led to tax treaties. And for anyone who's interested in the history, you would see how the development came. It wasn't just something that happened overnight, but was also picking from certain local practices, for example, among the cantons of Switzerland, and how they dealt with such issue. So the conversation in the 1920s led to model tax treaties. The speaker from ATAP already gave us a list of them, from OECD to the UN, and now the ATAP model. With the tax treaties, we now do have the potential or the presence of transfer pricing. And transfer pricing emanates from Article 9 of the model tax treaties. And that sort of gives birth to the relevance of transfer pricing. Article 9 simply says that in effect, right, even though if you read it, it does not use the word transfer price itself, but in effect simply says that we're going to treat companies within a multinational entity as separate individual entities within that block. And while treating them as separate entities, we would now demand from them to when trading with each other, ensure that they adopt what we call the arm's length principle. And for anyone who's a student of trade or businesses, or even just anyone who has read the works of Stephen Eimer, you would understand that the moment companies develop to become firms or multinational entities, there's a lot of synergy they intend to gain. And for that synergy to occur, there's a lot of centralization of control, of ownership, of management, and even also of funds. So that we have a sort of a disconnect between economics, where firms are centralized in their operations, and taxation saying that we will treat them as separate entities, and they now demand that they would act at arm's length. What arm's length simply means is that you would act as though you did not know each other, even though you're sister companies of a parent company. So basically, you can just picture asking siblings to act as strangers when they interact with each other, and anyone could start questioning the potential of that. So that analogy has now led to transfer price, in the sense that when a sister company transacts with another sister company or a parent company, the price that you fix for that particular trade or service must be the same price, or at least similar to the price that you would fix if you had traded with a complete stranger or a third party. Anyone would say that that shouldn't be an issue. That should be simple. But then what that has done over time is that it has now empowered companies to sort of push the rope in some instance, in the sense that for certain goods that are difficult to price, it becomes an owner's field as to what price I think a third party would have fixed. For certain services, for example, royalties, as we will see, that are difficult to value, then it becomes difficult to say what a third party would have fixed for that same royalty transfer. And in the absence of being able to arrive at what everyone would have come to agree on, then tax avoidance happens. And tax avoidance, again, as Lucky Star said, becomes an extended scope of illicit financial flows. One could argue one could ask, why must countries apply this provision in the model treaties? First of all, what we'll find again is that while these things are being couched as soft laws, they've grown to become hard laws. And I wrote recently on the role of soft law in global tax reforms and multilateralism at the seams. But beyond even bilateral tax treaties, what again you would notice is that even within countries, they've come to now adopt this provision that we'll find in tax treaties into their domestic laws, so that these provisions on the treatment of related entities has gone beyond simply that which is needed when you're entering into a tax treaty, to become that has now been enshrined within the domestic law. And for some countries like Nigeria, actually even applies to domestic transactions between companies of the same group. So, for example, if you take a bank that has an insurance firm, when they transact between themselves, even within the country, they would have to comply with this arm's length principle. And again, I'm happy to share a lot of these slides later. But from the analogy given, what we see now is that we have a plethora of cases where companies have now been able to, using different strategies. Some of you might have had double Irish Dutch sandwich, or even all kinds of other forms of tax planning, to basically erode tax bases in some countries and also shift profits to other countries. Now, the idea of transfer price is simply to reduce your taxable profit in a country that has a high tax rate and ensure that that taxable profit is declared in another country with a low tax rate or no tax rate. And that tax planning framework has now led to the emergence of tax havens, the likes of Luxembourg, Switzerland, Cayman Islands, Mauritius, and the list goes on, and the Netherlands to mention. So we look, for example, in Denmark, there was a case of Adecco where the court was called upon to determine whether the rate charged for royalty transfers was actually at arm's length, right? And the problem you would see again if you looked carefully in this space is that courts are keen to favor the taxpayers, not simply because of any form of corporate capture, but because of the difficulties. And I think previous speakers already spoke to the difficulty of transfer pricing. Because of the difficulty of determining what that transfer price should be, then courts will favor the taxpayer, right? So in Denmark, in Adecco, the court simply said that the Supreme Court of Denmark simply said that the authority had failed to establish that the royalty rate did not meet the arm's length principle. And we see the use of transfer price in royalty, or what you call intangible asset, but we also see it in even tangible assets. For example, in Glencore in Australia, where the issue was about fixing the price of copper, the court held that the party agreement between independent parties need not be directly equivalent or identical to demonstrate arm's length terms, and could simply evidence market behavior and industry practice to be sufficient. Now, remember again that in arm's length price, we're trying to determine that the price at which you would agree with your related party, the same price you would agree with an unrelated party. But here in Australia, the court is saying that actually that agreement need not actually be directly equivalent, but it will be sufficient to simply look at market behavior on industry practice. And the complexity of this is that in trying to determine price, the court is asking you to look at market behavior and industry practice. Then that becomes difficult for any taxpayer, for any tax authority to track, but also now empowers taxpayers to fix prices that they want to. If you go to Canada, where the issue had to do with uranium, the issue again came up, and basically the court said that the tax authority had not shown enough evidence that the taxpayer did not comply with the arm's length price. In France, again, there's a case of Philips. So excuse me, where the issue had to do with the use of the cost plus margin, which is one of the forms of establishing transfer price. And in the US, we're all familiar with cases of Amazon and Apple and how they get away with many of the requirements that they should do in terms of transfer price. But we have our own African-centric or African-centered examples. I mean, Kenya is one where we have the case of Unilever and the Commissioner General of KRA, and also Karuturu Limited and Commissioner General of Domestic Taxes. Unilever one had to do with transfer price fixed between a Kenyan subsidiary and a Ugandan subsidiary, and the Karuturu case had to do with the sale of flowers for export, and at what price those flowers were sold within Kenya. And we see again the difficulty of being able to establish transfer price. Publish what you pay. I said in one of their reports that between 2000 and 2010, Nigeria's crude oil export to the EU was overvalued to the tune of $1.6 billion, making Nigeria fifth among 30 countries of overvalued crude oil commodity sale. When I was doing my PhD and I got data from Uganda and Kenya, I found out that in many cases, companies undervalued their transfer price to the tune of almost 300%, overvalued to 300%, thereby decreasing the taxable profit in both countries. And that sort of gives you an idea of how much is lost through transfer pricing. And again, if you take out time to look at the Paradise Papers, you will find a plethora of examples of different schemes that are being used. But I think what again, just these two last two slides, moderator. I think what is important to mention is the socio-economic implications of transfer pricing abuses, right? And the first thing is that taxation is key to the character and functioning of the state, the economy, and society as a whole. So that the moment people do not pay the taxes that they should pay, then the country suffers. And we've seen this a lot with the way African countries have been able to respond to the COVID pandemic, and how you'd have countries actually being at the mercy of international organizations, whether it was speaking about the procurement of drugs, or even just palliatives to give to the citizenry, in the sense that because we have massive transfer pricing abuses or tax avoidance by extension, countries do not have the necessary funds to be able to meet these needs that they need to. But also, and then this leads to denial of basic economic, social, and cultural rights of African countries. But even beyond that is that the moment multinational entities who are the major explorer and exploiter of resources in African countries do not pay taxes, then there's a shift of the tax burden to individuals who are already, by any global metrics, are considered poor, right? And so, and that's why you find that there are many African countries that now you see increase of VAT, which is a tax on consumption, and one that is deemed regressive. You also see government trying to overburden SMEs and even just informal sector, simply because the multinational entities who actually have the ability and should pay more do not pay more. But even beyond that, there is just the ideology of internation and inter-taxpayer equity. You find report that says that Amazon paid zero tax in this year. Meanwhile, Amazon is $1 trillion company, and then some other person again in Kenya is paying 30% of their income in taxation. That inter-taxpayer equity is one that is not there, and one that, for those of us who are lawyers, you find that equity would want to step in that kind of situation. And finally, one may ask, what is the solution? The solution, again, quickly goes back to sort of the aligning economic reality of firms with taxation, with tax law, to say that we need to leave that erroneous concept that it's possible for sisters and brothers of a family to deal with themselves, except there's acrimony, as though they were complete strangers. And until we're able to align the economic reality that firms share a central control, ownership, management, and taxation must treat them as a single entity, then we would keep missing the point, because every other solution, again, and Joy has mentioned a few of them, would fail to meet the required standards, simply because we keep looking at firms with a lens that is not true. And I think that might be a good place to stop. And I'll be willing to take questions when time arises. Thank you for the opportunity.
Thank you very much, Alex, for that very interesting presentation. I don't envy you and Joy presenting topics like this in such short time. I think what I forgot to mention earlier was that Alex is a tax planning expert. You can see that from his presentation, but we are thankful that he has not used it against Africa so far. I mean, on a more serious note, speaking to the difficulties of transfer pricing, I mean, from my experience, I know even transfer pricing audit alone takes several months before it even goes to the court. And also you can appreciate what Alex is trying to make you understand in terms of the complexities and difficulties of transfer pricing. I think what I like most is that how you are able to link it to the opportunity cost, right? And how that sort of the challenges exacerbate inequality in Africa, and then the importance and the need to address these issues. Thank you very much. So now we go on to our last speaker of the session, Ms. Mokupa Nsendiluka. She's a development professional and a natural resource governance expert. She's currently the policy officer on tax and natural resource governance at the Tax Justice Network Africa. She will be presenting on tax revenues, challenges with extractive companies. Mokupa, the floor is yours.
Thank you, Mustafa. So I'll be speaking to elements around tax revenues and the challenges, particularly in the extractive industries. My name is Mokupa Nsendiluka, and I'm the Policy Officer for Tax and Natural Resource Governance at the Tax Justice Network Africa. Next slide, please. Yes, so my presentation will give just an overview of what I'll be talking about through an introduction and background. Then I'll proceed to give an overview of the IFFs issue in the context of the extractive industry, and then present some of the key challenges that are faced around taxation in the EI sector, and then just prompt a little bit about thinking around what reimagining or rethinking taxation in Africa's EI sector would look like. And then we will then go into looking ahead to some of the opportunities that are there for reform in the sector. Next slide, please. Next slide, please. So why is this discussion important? I think, as has been mentioned by previous speakers, Africa is facing a time when resources are much needed to fight the COVID-19 pandemic, as well as deal with the already existing challenges around poverty and inequality. The EI sector presents sort of like the cash cow to address these challenges. And we see that for Africa, particularly sub-Saharan Africa, 62% of the total exports come from the extractive industries, particularly oil, minerals, and metals. And we see that that's a significant percent in terms of contribution to trade. This invariably means that the EI sector has a big influence on the rates of economic growth and the amount of tax collected by governments from the sector. Next slide, please. Next slide. So as has already been mentioned, I think the latest data shows us that about 89 billion is lost annually through illicit financial flows, and particularly around the extractive sector. The UNCTAD report, which was released last year, links the export of primary extractive resources estimated at 40 billion USD in 2015, and over the past decade from the year 2000 to 2020, estimated an amount of 278 billion lost just from the extractive sector. So we see an increasing trend when it comes to financial crimes in the sector. And but more specifically, IFFs are concentrated in high value, low weight commodities, especially gold, diamonds, and other precious minerals. Of the estimated $40 billion of IFFs derived from the extractive commodities, the report finds that in 2015, 77% were concentrated in the gold supply chain, followed by diamonds at 12%, and then platinum at 6%. So we see that there is a high amount of financial crime in the extractive industries, but particularly on these high value, low weight commodities. Next slide, please. So I'm going to share some of the challenges that are faced when it comes to taxing this industry. And this is drawn from the work that we've done through our research and advocacy efforts through our partners, as well as ourselves at a continental level. So one of the issues that exacerbates the problem of IFFs in the EI sector is this dominance of foreign multinationals. And previous colleagues have already spoken to that from different angles, but we see that the increased participation of foreign multinationals in the sector, from exploration stage to production to exportation, exposes the sector to increased corporate tax abuses. Again, there's this unrealistic expectations, or perhaps I'll term it a misunderstanding by governments and on the long-term nature of the extractive industries. So once a project begins, how long does it take for it to materialize to a point where we start to break even, and then they can start to pay a tax on profits? A big challenge, again, that governments on the continent face is the inadequate geological information in terms of knowing the value of resources in the extractive industry. And this thereby undermines their ability to adequately design fiscal regimes that would then meet the value of what's in the sector. So usually we see, for example, governments relying on the data that multinationals present to them during exploration stage. And with that data, they then design fiscal regimes that the extractive companies would then be charged against. So we see that this presents a big challenge, because how reliable is the data that the companies submit to the government, and in ensuring that we maximize revenue collection. Poorly designed and negotiated fiscal terms in the different mining, oil and gas contracts is another big challenge, and this particularly tied to the overly generous tax incentives locked in fiscal stabilization clauses. So deals that are poorly negotiated in terms of fiscal incentives, which then undermines our DRM efforts from the sector. Another big one is the inadequate administrative capacity by revenue authorities to administer and implement these fiscal regimes. So yes, if you have a well-designed fiscal regime but lack the capacity to implement it, then you have a problem there. So this has been something that's been problematic in Africa. Next slide, please. We also see that the over-reliance of profit-based taxes in the sector exposes it to corporate tax abuses. So taxes like corporate income tax, where companies can manipulate costs, then undermines our efforts to get the most that we can in terms of taxes from the sector. Price volatility of oil, gas, and minerals can be problematic in the sense that the sector is operating in a context that is constantly evolving. So for instance, just last year, we saw the impact the COVID-19 had on oil and gas prices. We saw oil prices plummeting whilst gold prices appreciated. So then how do extractive companies continue to operate in a context like that? But also how do governments continue to maximize collection in times when prices are volatile? Policy inconsistencies is another challenge. We've seen that policies are developed on a short-term basis when the extractive industry by nature is a long-term industry. So for instance, an example I can cite here is the Zambian government that has changed its mining tax regime at least 10 times in the last 15 years. This makes it unpredictable for extractive companies to operate sustainably, but also in times of windfalls, when prices have gone up, the government then misses out because then it's constantly shifting when it comes to the different fiscal instruments it's applying to the sector. Mistrust is a big thing. I think when it comes to taxation, trust is critical amongst the key stakeholders that are involved. And so we see that there's an increased mistrust between investors and government, and that trust levels have been eroded over time. And this therefore affects the ability to engage meaningfully on issues around taxation in the sector. The opacity and secrecy in the signing of deals in the extractive industries is another challenge. So due to the limited to no transparency and accountability frameworks around the agreed terms between government and investors, we are asking questions about who are the true owners of those investments that are being made in the country, but also the different fiscal terms on a project-by-project basis. What are the agreed fiscal terms that have been designed, for instance, with Glencore, Vendetta, and other companies? So this is a challenge that has presented itself and has sort of undermined efforts to meaningfully maximize revenue collection from the sector. Next slide, please. Now, in terms of just trying to think about what would rethinking taxation look like in Africa, particularly in the extractive industries, there's a few pointers there that I've brought in terms of looking at it holistically, but more importantly, local solutions. So next slide, please. So looking at this discussion more broadly, the question then becomes, how do we design fiscal regimes that build in elements of predictability, stability, and flexibility from the onset of this extractive project? And I think for investments to thrive, for companies to meaningfully invest in sectors, there has to be predictability or some certainty in terms of operations. So the political context, in terms of conflict, will the investors get their meaningful gains in a context that is stable and also flexible at the same time? In terms of flexibility in a fiscal regime, governments, for instance, could consider implementing sliding scales on royalties, as well as applying a tax on surplus profits to ensure a larger share is collected when commodity prices are high. And I think this we've seen recently, for example, in Southern Africa, copper producing countries like the Congo DR, as well as Zambia. We've seen that copper prices have gone up to 9,000 USD per ton. And so the question becomes, how then do you ensure that your fiscal regime is flexible enough for you to adjust in order for you to leverage off the gains of these copper prices? Governments, again, should resist offering overly generous tax incentives. If an extractive project cannot bear the royalty or normal tax on equity investment, it is unlikely to not be a good deal, because governments risk losing out when the context changes. And I think I've already alluded to this. So when you have a copper price boom, or you have new technology that increases efficiency in terms of operations, these tax incentives make governments lose out on potential revenues they could collect. Lastly, again, on this slide is governments must be very clear on what they want to achieve from the extractive industries in terms of their national development plans and priorities. Clear objectives often result in well-designed fiscal regime. And I think this goes without saying that when the objective is clear, it is easier then to set up a fiscal regime that responds to that objective. So whether it's setting up a sovereign wealth fund, or ensuring that more locals participate, or a minimum revenue sharing mechanism there, termed as MRS, it's very critical that governments have clear priorities that then enables them to design fiscal regimes that responds to those development plans and priorities. Next slide, please. Okay, so now this slide focuses more on the local solution. So in terms of looking at policy and regulatory frameworks, I think it's important that Africa got to a point where we started to develop more homegrown models and solutions to taxing our industry. And conversations need to move from taxing raw materials to taxing value. Frameworks like the AMB present a very good opportunity for us to move in that direction. And so domesticating the Africa mining vision, which is a vision that really promotes Africa-driven solutions in the extractive industries to domesticate this vision to country mining level. Local content is another big discussion. So beyond taxing, beyond talking taxation, can the extractive industry provide direct linkages to the local economy? Mining projects must be rooted in the local economy to provide spillover effects to other sectors such as banking, insurance, transportation, warehousing, security, and processing. And this then ensures that locals benefit from the sector. Artisanal and small-scale mining is another big piece of the discussion when we look at locally driven solutions. So formalizing of the sector becomes important because it presents a huge opportunity to maximize revenue collection in-house, as well as encourages the participation of local players. So for example, how do we ensure that local players benefit from emeralds that can be polished to make rings that can then be sold in their finished product to the international markets? And the Africa Continental Free Trade Area deal, which was recently enacted, really presents a great opportunity for Africa to leverage off this. Again, how do we incentivize local participation, especially the women in mining, to participate in the sector? And there, again, the issue of taxation comes into play in designing fiscal regime that accommodates the artisanal and small-scale mining sector. I think what we've seen in some countries is that the same fiscal regime that applies to large-scale companies is the one that applies also to small-scale players. Now that, in terms of encouraging participation, is retrogressive. So how do we encourage governments to develop fiscal regimes that are nuanced and specific for artisanal and small-scale players, but also for the large-scale players? Next slide, please.
Mokupa, sorry to interrupt. We're not doing so well with time. So if you could wrap up in a minute.
Okay, no problem. I'll rush through these next slides. Basically, please, next slide, please. Basically, in looking at the opportunities ahead, I think the discussion then becomes, how do you ensure that the awarding of extractive projects is done in a transparent and competitive manner? Because poor governance results in effective tax regimes that are developed, but also, again, the issue of trust and building consensus between the key stakeholders, which is private sector, government, and civil society. The EITI there presents a great opportunity. The discussion on the energy transition and how governments can pre-position themselves to maximize collection. We've noted countries like Congo DR have decided to review their current contracts to ensure that they look into this. So how do we ensure that the energy transition works for us in terms of maximizing collection? Next slide, please. The increasing role of China becomes an important discussion in the extractive industries. So we've seen China increasingly taking over many projects on the continent. What does this mean for the transparency and accountability discussion? And how then again do we deal with issues to do with contract transparency and secrecy? The tax policy reform processes, which are mostly northern driven, the G7 OECD tax proposals, for instance, and the energy transition discussions, which are mostly northern driven. So again, as Africa, how do we find ourselves sitting at the table in these conversations to ensure that we meaningfully benefit from the overall tax system? Next slide, please. So lastly, basically, as a tax justice movement, I think for us, our core is to ensure that mining works for the local people, and local people here is Africa. So we have a great opportunity ahead to ensure that mining works for us through frameworks like the Africa Mining Vision, the EITI, but also keeping in mind that extractive resources are finite and non-renewable. And so if we don't benefit now, there'll never be a time for us to address our poverty and inequality challenges. Thank you, Mustafa.
Thank you very much, Mokupa. Thank you for such a very detailed presentation on a very important topic. I think one takeaway from me is what you highlighted, the need to have very clear objectives in terms of what you want your extractive industry and the revenues and resources you generate from there to achieve for a country. You look at countries, my country, Nigeria, over the decades, it's not entirely clear. And I mean, from Alex's presentation, you could see that the opportunity cost in terms of not administering the extractive industry properly is that it exacerbates inequality. It has a lot of negative implications for development. But if you go to countries like the UAE, you'd see that, I mean, they have their negatives, but in terms of what they've done with the extractive industry, you'd see that the extractive does not constitute a huge portion of the public expenditure, public revenue. So I think that this is a very important point for us to take away. So we are not doing so well with time, so we'll take a few questions. The first question here is for Alex. I'll just read it out. How does transfer pricing abuses deny the basic economic, social, and cultural rights for African countries?
Just quickly, I'd say that there are 4 R's of taxation, and the 4 R's basically say, why do you even impose tax in the first instance? One is to raise revenue, the other is to reprice commodity, the third is to redistribute wealth, and the fourth is to reform behavior. Now, transfer pricing abuses would affect 2 of those R's, which tie to the economic, social, and cultural rights that you mentioned. The first is that when there are transfer pricing abuses, they are not able to raise revenue, and then that way it affects the economy of African countries. But the other important one, really, I mean, 2 other important, to redistribute wealth, which again we could overlook, but the more important one, which goes to both social and cultural rights, will be the issue of behavior, right? The moment I know that someone is not paying taxes, because we all believe in fairness as part of our culture and also our social values, what would happen also is that voluntary tax compliance becomes difficult. We tend to learn a lot from our neighbors. And so if people are aware that multinational entities who should pay taxes, who have the ability to pay taxes, are not paying taxes, then you find justification. And when you look at papers by Neil McCulloch and guys who have looked at the reasons behind voluntary non-tax compliance in many African countries, one of the reasons goes to the fact that there are people who don't pay taxes, whether they are high net worth individuals, whether they're multinational entities, and as such, others think that they shouldn't pay taxes. So you sort of have that connection between the 4 R's of taxation and the sort of the economic, social, and cultural rights of African countries, and how they sort of marry in this context. Thank you.
So Joy, one question is, what do you think about country technologies meant to combat IFF? And I think this will speak to your experience dealing with different countries in interagency, inter-country cooperation.
I was just reading this question and thinking about it actually. And I think I have to contextualize it, but I also have to put a caveat on it. One is that, the way that technology emerges is mainly by creation of the private sector. And so we cannot really say that they are meant to combat IFFs, right? What we can say is that we are innovating to use the technology that's emerging to combat IFFs. So we're using it for data management. We are creating new means and methods, right? But I think I want to contextualize your question because it's an important point within it. Currently at the WTO, you have the e-commerce negotiations going on, and that's the plurilateral. And they are currently deciding about the rules of transfer of technology, for example, or localization of content relating to technology, the ability of countries to demand that a company using certain technology has, for example, their data centers based in your country. And it's important to have the data centers or to be able to access the what's behind the ownership of a specific type of software. So you can look behind it and see the original creator or who has contributed and created value. And these are very important, not just about combating IFFs, it's also about taxation, because if you're able to track or see where value is being created, where maybe Nigeria, South Africa, they contributed to the creation of this software, then there may be a right to tax, even if there's no physical presence attached to this right. So indeed, what's happening is not a monopolizing of technology, it's almost a monopolizing of ownership and the way this technology can be transferred and adapted or adopted. And I think it's very important that we begin to engage in this debate that's going on at the WTO level. And I do believe it will become a concern for the CFTA as well, is how we want to treat e-commerce and how we want to treat the use of technology, the transfer of technology. So indeed, that's a very important question. I encourage everyone to get engaged. The Africa group at the WTO have expressed that they are not happy with this this agreement for very many reasons, including that no one is actually prepared to know, use and widely use and adopt technology across the continent right now. And so it would not make sense to adopt these e-commerce negotiations if we don't know the implications as yet. Very much like the Doha round, there's the developing versus the developed countries. So it's a very important question, and I encourage everyone to engage in that debate. Thank you.
Thank you very much. Unfortunately, we have to come to an end to this very, very interesting session filled with stellar cast speakers, like I mentioned earlier. Thank you very much to the Global South Dialogue on Economic Crimes for hosting this session, to the very wonderful speakers, Joy, Alex. Thank you very much.